Welcome everyone. In today's video, I wanted to talk about why layer 1 blockchain tokens are often the best investments. Now, what I mean by this is that, your tokens like ETH, AVAX, SOL, ADA, those are the tokens over time that are going to accrue the most value and are going to be the most valuable in the market. I expect, in the 3 to 5 year time horizon that these are going to be the most valuable in the top 10 for like crypto market caps. You're not going to have, DeFi tokens up there in the top 10. It's all just going to be layer 1 smart contract chain tokens. So this video isn't meant to be, a video to fudge you out of all of your DeFi bags or, any of your NFTs. But I think it's, worthwhile just seeing the other side of the argument, because a lot of you will think that holding these DeFi tokens is going to be a better investment than these layer 1 tokens, but I just want to show you the other side of it, right? So let me just show you a couple of charts first to just initially illustrate my point. So for example, we have here the Uniswap token charted against ETH, and in the top right here we have the drawdown. So ETH versus Uni versus ETH, we can see that there's roughly an 82% drawdown in the price of Uni versus Ethereum, meaning that you would have been way better off holding Ethereum, at least since the 24th of March, than you would have been holding Uniswap token. Now, this is only for the Ethereum ecosystem, but I'm going to show you more over time as well. So let's just check out SushiSwap. Similar deal here. It's down 88%, and in fact, it's probably worse. If I just take this here, it's down 94%, but I set this indicator to go back only like the past 350 days, so like the last year. But if we go back as far as possible, it actually gets even worse and illustrates my point even better. You were way better off holding ETH than you were holding Uni or Sushi. Now let's take a look. Aave as well, so that's down like 78% against ETH. Now that's only Ethereum DeFi. Now let's take a look at, say, Solana, for example. So this is Ray, down 94.91% against Sol. Serum, down 93%. In fact, I think that's even worse. Yeah, probably closer to 97%. Now let's take a look at Anchor. So this is against Luna. You've done very poorly if you've owned Anchor over time versus, like holding Luna. Let's take Mirror Protocol, down 98% against Luna. In fact, it's probably worse again. It's probably closer to 99%. And lastly, let's just take a look at Yearn Finance, for example. Again, this one, about 93%, so actually worse than what you see up here. And so I think, that helps illustrate my point, right? You can see why I might say that layer 1 blockchain tokens are often the best investments and going to hold up over time. And this is the reason why, like, Bitcoin maxis are the way they are, because most of the altcoins out there, or the altcoins all the way up until like 2018, they just bled value against Bitcoin over time. If you chart Litecoin, Bitcoin Cash, Tron, EOS, a ton of other alt tokens from like previous cycles, they just failed to retain their value in Bitcoin terms. So you're almost always better off owning Bitcoin versus most altcoins. And now I think that with the rise of layer 1 blockchain tokens that actually have ecosystems there, DeFi, NFTs, you're going to see something similar with those tokens versus DeFi tokens or NFTs. And so there are several reasons for this, and I'm going to explain them in this video. And so the first point I want to say is that these tokens are actually useful in the sense that they are used for gas to send transactions. On Ethereum, for example, if we look here, and this is the Ethereum average transaction fee. I mean, it's gone up as high as like $69, $70, but your average, fee for an Ethereum transaction is going to be like, $4 or $5 roughly. But this depends on if we're on a bull or bear market. When we get into bear markets, gas gets really cheap. When we get into raging bull markets, it gets quite expensive. But if you're transacting on Ethereum, you're naturally going to have a bunch of ETH in order to actually make sure your transactions go through, and you don't want to get stuck in the middle of something. Say if you wanted to, do some leverage trading, or you wanted to top up your collateral in Aave, you don't want to be caught short without enough ETH. And so people will buy a ton of ETH and hold it in their wallet, even if they're not particularly bullish on the price of ETH. And so that helps prop up the price. So that's what makes those layer 1 tokens useful. I mean, with Avalanche and Binance Smart Chain, you have something similar as well. But when you're using stuff like Harmony, Phantom, or Solana, it's not really as necessary to hold the gas token, or it's not as necessary to hold a bunch of it because the fees are quite cheap. But however, it's still required to have that token to actually use that particular blockchain. DeFi tokens, however, are not used to actually use DeFi. For example, the Uniswap token is not relevant when actually using Uniswap. Like, you don't have to have that in your token to unlock the ability to do swaps on Uniswap, which is good because that would be really bad for user experience. Imagine having to hold the Uni token in order to swap on Uniswap. But it just means that it decreases its utility, and so people aren't going to bother holding it for the most part, right? ETH is required to use Ethereum, and when it's required, it means people must hold it. Now, the second reason is that, these gas tokens, layer 1 smart contract blockchain tokens, they're often used as money to buy NFTs. So I'm on cryptoslam.io here, and we can see the NFT collection rankings by sales volume over time. And we can see that here we have CryptoPunks. It's second. It's had, $2 billion worth in sales. Now, that's in dollars. However, it's all been transacted in ETH. So about 729,000 ETH has been used, to trade CryptoPunks over time. So if you wanted to buy a CryptoPunk, you have to buy ETH and then swap that ETH for a punk. If you want to buy a Bored Ape, you use ETH. And R-Blocks, you use ETH. And Azuki, you use ETH. Do you get what I mean? And if I go down here, a Solana Monkey Business, you're going to have to use Sol in order to buy one of these SMBs. And, it just goes on and on and on. And if you go here to blockchains by NFT sales volume, Ethereum has done $19 billion in sales. However, that's all been in ETH. Well, mostly been in ETH. Solana, $1.2 billion, and that's going to be in Sol. Polygon, so that's in the Matic token, and Avalanche in the AVAX token as well. And we know that there's, a massive subsector of crypto culture that is entirely in NFTs. They don't care about DeFi. They don't care about anything else. They don't care about the tech behind it all. They just want to use use ETH to buy a punk, to buy a Bored Ape. And so they're going to hold a bunch in their wallet, and that's also, going to prop up the price of ETH, or prop up the price of the underlying blockchain token over time as well. Additionally, a lot of these smart contract blockchains are now proof of stake. And when a blockchain is proof of stake, it means that you are able to stake that coin for a risk-free rate. And so it just adds further utility. So if you're going to have to hold this token anyway, as gas to send transactions, you might as well start earning yield on it. So for example, you can stake your Sol, get about 5.86% APR, Luna 6%, ETH 4%, Cardano 5.29%, Avalanche, you can stake your AVAX for 9.16%, that's quite high, Polkadot 13.9%, Cosmos 13.95%, which is pretty decent as well. And this attracts the crowd of people who are very much into, say, like dividend investing as well. They're big fans of generating passive income. And so you are going to have people who are dividend investors but use crypto instead. And so they like to get yield on their Sol, they like to get yield on their ETH, they like to get yield on their BNB, for example. and that will drive value over time as well. Additionally, you can use a lot of these tokens in the DeFi ecosystems. For example, on Solana, you can take your SOL, take it to Mango markets, and then use it as collateral, and then you can trade various different perp markets. So you can trade, ADA, AVAX, BNB, Bitcoin, ETH, FTT perps using SOL as collateral. I mean, you don't need to use SOL as collateral. You could also use like ETH as collateral. Additionally, because you can use these tokens in DeFi, it means that it gets locked up in a lot of DeFi protocols, and that reduces the circulating supply. It gives the underlying blockchain token, a monetary premium. We are going to have to take into account some special considerations as well. So for example, EIP 1559 drives direct value to ETH token holders. So if you weren't familiar with EIP 1559, it's an Ethereum improvement proposal, but effectively it means that when you do a transaction on Ethereum, part of that ETH gets sent to the miners, and then another part gets burnt. And since EIP 1559 has been implemented, about 1.957 million ETH has been burnt, and that's almost $4.9 billion in value. And so that's ETH that wasn't given to miners, who would then have to sell, because miners have to pay for electricity and mining equipment. And so that's 4.95. So that's $4.918 billion of selling pressure that's come off the market, and that directly benefits every ETH token holder. Now, EIP 1559 burning mechanics, they have been applied to various other different blockchains as well. So Avalanche, Binance Smart Chain, Solana, Polygon, they all have similar mechanics as well. However, people don't really talk about that as much because they don't generate anywhere as much in fees, and so therefore the fee burning isn't as considerable, but it's something to keep in mind as well. And then we also have to talk about Luna. So they have their own special deflationary mechanism. So the higher that the UST market cap grows, the more Luna is burnt over time. And so if supply decreases and demand stays the same, naturally a token is going to pump, and so there is value. And so there is value accrual there as well. And another thing I wanted to mention is that most blockchains cannot be accurately valued, whereas TradFi metrics can actually be accurately applied to DeFi protocols. So for example, Adam Cochran, he was very bullish on Yearn. He put out this tweet here just talking about Yearn and how good they are, right? So they say here they make $100 million a year in fees from vaults, and that is not based on incentives or dilutive tokens. They have a treasury of $100 million plus that is earning interest. They have a high TVL, market cap, whatever. Their price to sales ratio is 3.6, and their PE ratio is 7.9. Now, if you're familiar with TradFi metrics, the price to sales ratio and price to earnings ratio, these are extremely good deals. Right, it means that the business is extremely undervalued when you compare it to other businesses. I think the average PE ratio for an S&P company historically has been like 20 PE, and so if Yearn Finance was a stock, it'd be extremely undervalued. However, when you start applying TradFi metrics, to a DeFi token, it actually takes all of the magic and the mimetic value out of it, because now you can properly value it. Investors are going to see when it's overvalued and they're going to sell. However, example, Cardano, when do you know that it's undervalued or when it's overvalued if you cannot apply proper TradFi metrics to it? You can't really. However, you can see when Yearn Finance is undervalued or overvalued. And in fact, Yearn Finance might be undervalued, but if we see its price performance against ETH over time, it's down like 90+%. Yeah, 93%. At one point, someone paid 112 ETH for one Yearn Finance token. I mean, the value of that now is 7.36 ETH, which is pretty incredible. And I expect this trend to continue as well. And the last thing I wanted to bring up is that most DeFi tokens are insanely inflationary. So you've done yield farming before. Now those yields mainly come from inflationary token rewards, right? With Orca, for example, they pay out like hundreds of percent APR for people who provide liquidity on their platform. But all that happens is that those tokens are just like relentlessly sold into the market by leverage yield farmers, by mercenary capital. And so the price of Orca has gone down massively over time. If we just take a look at this, it reached about $20. If you can see here, the all-time high was $20.33, and it's down about 90% since then. I mean, the general market has taken a dump since then, but when you add in token inflation as well, it's just going to be hard for, the price of Orca to actually go up over time. Additionally, we're going to take a look at Serum, for example. So this is probably going to be one of the worst culprits for having a low float, an extremely high fully diluted valuation. So the market capitalization of Serum right now is $238 million. However, the fully diluted value, meaning the max supply multiplied by each, by the token price, it's actually $18 billion, which is actually ridiculously high. So the circulating supply right now is 133 million tokens, but the max supply that can ever come into the market is $10.1 billion. Now, I think I saw one of the tokenomics sheets for Serum, but I could be wrong on this. But effectively, all of this supply is going to come into the market within the next 5 years. So the circulating supply of Serum is just going to there's going to be so much Serum flooding the markets over the next few years that it's going to be hard for this token to pump. And in fact, I feel confident in saying this is going to be a worse investment versus holding Sol. I'm very confident in saying that. Like, I showed you this chart here. This chart is going to continue to make fresh all-time lows. It might not be now, it might not be in a year's time, but over a 3 to 5 year time frame, you're going to have regretted holding Serum versus holding Sol, purely because all of this supply is going to flood the market. And so that just ends off my point. Most DeFi tokens are insanely inflationary, and there's going to be a ton of supply entering the market. Now, this isn't to mean that you should buy all layer 1 smart contract blockchain tokens. So if we take a look at CoinGecko, you can find these tokens, right? So if we go to categories and smart contract platforms, so these are all the tokens that I'm mostly talking about that are going to be the best investments over time. So, Ethereum, BNB, Terra, Solana, Cardano, Avalanche, Polkadot, Polygon, Near. Those are going to be the ones that, probably perform the best over time. Phantom as well. Now, that doesn't mean to go out and buy all of them. For example, Tron is basically worthless. This thing has performed terribly against ETH over time. There isn't really an ecosystem being built out there. And Justin Sun has, stepped down from Tron as well. So avoid Tron, EOS, Zilliqa, Tezos, Algo, and Flow. I feel very confident in ignoring Flow because I don't think much is going to come of it. Neo, do you remember this when this was going to be like, the Chinese Ethereum? There are a bunch of others as well that marketed themselves as like, a smart contract platform. Qtum, you can easily fade this. Zilliqa, I spoke about that before. You can fade that. Icon can be easily faded. But what I'm trying to say, right? The ones that actually have thriving DeFi ecosystems, that have NFTs there as well, that have proper builders coming along and actually wanting to use their platforms, those are going to be the ones that, accrue a lot of value over time. Now, I made this post on my YouTube page. I said, here's the deal. Smart contract, layer 1 blockchain tokens are the best investments. And then I had a couple of people just, comment on it. And I had one comment here saying, I agree. But if this is true, then isn't holding NFTs which are sold in the layer 1 tokens an even better approach? Now, I would say no. I've shown you here a bunch of these, DeFi tokens over time, performing against like Ethereum or performing against Sol. And because you can't accurately chart most of these NFTs, you don't see it, but you would probably see this, as much, if not more, with a lot of these, NFTs, right? I think you might be seeing a lot of the top NFT sets like CryptoPunks or Bored Apes or Azukis, and thinking, that's what it's going to be like for a lot of NFTs, but a lot will just bleed against ETH or whatever their underlying, blockchain token is over time. And if you could chart them accurately, this is what, most of those NFT charts would look like over time. So thank you for watching. I hope this, gave you something to think about. I don't mean to, fudge you out of your bags. If you have strong conviction over something, then that's more important than listening to whatever some random guy on YouTube says. So thank you for watching, and make sure to subscribe for more videos like this one.